This is your Mortgage Rate Watch for Thursday, February the 10th, and I'm Keith Akada with the Mortgage Reel. Finally, yesterday we get some much needed support from the 10-year bond auction. They got an A+ rating, and if you look from right to left on the bond page here, you'll see that yesterday's auctions went off very well, and that resulted in the rates improving. Across the board, all of our lenders did have a reprice for the improvement, which was much needed support, again, after 8 consecutive days almost of a landslide and interest rates increasing. Here on the tier, what we're really looking at today, though, it's what's going to be coming out at 10 a.m. our time on the 30-year bonds. This is crucial for the mortgage market on how these auctions react and what type of investors come in, because as of yesterday's 10-year bond, both local and global investors did purchase the 10-year auctions. Here at 10 a.m. this morning Pacific time, $16 billion in 30-year bonds will be auctioned off, and this is again going to be crucial on how the mortgagers react. What really investors are looking at right now is both how much is going to be purchased locally and how much is going to be purchased from foreign markets. Again, this is a true tale on what the belief is globally in the strength of the U.S. economy and our fundamentals as far as financial policy. So it's really going to be a true tale sign, especially coming off of the comments made by the Federal Reserve yesterday about quantitative easing 2 and their outlook of still continuing with that stimulus plan and moving forward. Yesterday, the Federal Reserve and Mr. Ben Bernanke made stern comments about what they feel is going on with the economy and how they feel quantitative easing 2 is still necessary in order to lower unemployment, boost the stock market, and create inflation. The government, though, had several questions as far as the board raising concerns about how much inflation was going to be created and how soon that would come. Well, here, just on the heels of that, it was now anticipated that in December of 2011, there was only going to be about a 20% chance that the Federal Reserve would hike the interest rates. Now the predictions coming off of yesterday's board meeting from the Federal Reserve has an 82% chance that the Federal Reserve is going to hike. You know, we made comments on this before that there was a 100% chance it was going to come in January. Well, now that's moving back into December of this year. And when we talked about January 2012, that was initial thoughts, and now the gamble has moved into this year. So here's the key thing. If you're on an adjustable rate mortgage, you have a home equity line of credit, all of those are going to be impacted by this. The closer we get toward the end of the year, the better the economy gets. If they roll out quantitative easing 2, this is all going to put tremendous pressures on the short-term indexes. When those indexes start to move, you can guarantee it, if you're on an adjustable rate mortgage or a home equity line of credit, it's going to cause those rates to move up overnight. Make sure to check the homepage of Homeowners Education 101 on the increases of the credit risk pricing that was just implemented by Fannie Mae and Freddie Mac and how that impacts any current or future homeowner that's thinking about either refinancing or purchasing in the very near future. Leave any comments or feedback below, as it's not only appreciated by Team Mortgage Reel, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks and like us when you're there. Otherwise, we'll be back tomorrow with more updates on your Mortgage Rate Watch.